Most people believe you need a lot of money to start investing, but that's not entirely true. What if just $100, something most people would easily overlook, could be used to start building real financial value? Instead of spending that $100 on things you'll forget about next week, what if it could be redirected into something that quietly builds value financially over time? In this video, I'll show you 7 things you can buy with $100 that are used in real investing and how people use them to build wealth over time. Stay until the end because the last one is often the most overlooked by beginners, yet one of the most widely used by serious investors. It's also important to be clear about something. These are not shortcuts to wealth. Let's begin.
Item 1. Stocks and index funds. What are stocks and index funds? Stocks are small ownership pieces of a company. When you buy a share, you become a partial owner of that business. While index funds are different. Instead of buying one company, you are buying a bundle of many companies at once. For example, a fund that tracks the overall stock market or a group of large companies. So in simple terms, shares equals buying a small piece of one company, and index funds equals buying a small piece of many companies grouped together.
What are the possible returns? Returns vary depending on the market. Historically, yearly returns is between 10 to 12%. For instance, the return for last year in the U.S. market for index funds was 22.2%, according to RBC Wealth Management Report. Meaning, if you have bought index funds in 2025 with $100, your money will be $122.2.
What are the risks involved? Share prices go up and down daily. No guaranteed returns. You can lose value in the short term, but not in long term. Individual companies might perform poorly, so index funds reduce some risk by spreading money across many companies, but they do not remove market risk.
How much do you need to start? You don't need a large amount. Many platforms allow you to start with as little as $1 to $10 using fractional investing. Practically, $50 to $100 is enough to begin meaningfully. Your $100 can be split across multiple companies or funds. Now, while shares and index funds are focused on business growth over time, the next option is completely different because it is not tied to companies at all.
Item 2. Fractional artwork. What is fractional artwork? It means owning a small share of a high-value piece of art. Instead of buying an entire painting worth hundreds of thousands or even millions, investors can collectively own portions of it. So rather than one person owning the entire artwork, many people each own a fraction of its value.
What are the possible returns? This is not a fixed return asset class. Some fractional art platforms report that certain artworks have appreciated over time when their underlying pieces increase in valuation or are resold. However, returns vary widely depending on the specific artwork. Some pieces appreciate, others remain flat for long periods. Liquidity, selling quickly, is not guaranteed. So, unlike stocks, there is no consistent yearly return range.
What are the risks involved? This is a higher uncertainty asset compared to stocks or bonds. Main risks? No guaranteed appreciation. Art might remain stagnant for years. Liquidity risk. It may be difficult to sell your share quickly. Valuation subjectivity. Art value depends on demand, trends, and collector interest. Platform risk. Your ownership depends on the platform managing the asset. How much do you need to start? Fractional artwork is designed for small investors. Some platforms allow entry from around $50 to $100. Many pieces are divided into thousands of small shares. This allows exposure to high-value art without buying the full piece. Item 3. REITs, Real Estate Investment Trust. What are REITs? REITs are companies that own and manage income-producing real estate. Instead of buying a building yourself, you buy a small share in a company that owns many properties, such as apartments, shopping centers, office buildings, warehouses. So rather than being a landlord, you are indirectly investing in landlords.
What are the possible returns? REIT performance varies depending on the type: residential, commercial, industrial, etc. From 1972 to 2023, REIT has delivered an annualized total return of roughly 11.3%, according to Nareit, though returns vary widely year to year.
What are the risks involved? REITs are generally considered moderate risk investments, but not risk-free. Main risks? When interest rates rise, REIT values can fall. REIT prices still move like stocks. Some property sectors perform better than others. During recessions, rental income can decline. So while REITs are linked to real estate, they still behave like traded financial assets.
How much do you need to start? REITs are very accessible. Many REITs are traded like stocks. You can start with as little as $10 to $100 using fractional investing. $100 can already give exposure to multiple real estate sectors. This makes them one of the simplest ways to enter real estate investing.
Item 4. Treasury bills. What are Treasury bills? Treasury bills, often called T-bills, are short-term loans you make to a government. When you buy a Treasury bill, you are essentially lending money to the government for a specific period of time. In return, the government pays you back more than you invested when the bill matures. Unlike stocks or real estate, Treasury bills do not give you ownership in anything.
What are the possible returns? On average, U.S. Treasury bills have recently been yielding around 4 to 5% annually, depending on the maturity period and interest rate environment. In 2025, the average 3-month Treasury bill yield was roughly 4.1 to 4.2%, while some periods were slightly higher or lower.
What are the risks involved? Treasury bills are often considered among the lower risk investment options available. However, they still have risks. Inflation may grow faster than your return. Future rates may become more attractive after you've already invested. If investing in foreign Treasury bills, exchange rates can affect your returns. The good news is that default risk is generally very low when dealing with financially stable governments.
How much do you need to start? You can start with as little as $100. The trade-off is that the returns are usually lower than what you might get from higher risk investments like stocks. Item 5. Gold and silver. What are gold and silver? Gold and silver are precious metals that have been used as stores of value for thousands of years. Unlike shares, REITs, or Treasury bills, they do not represent ownership in a company, and they do not pay interest or dividends. Their value comes from what other people are willing to pay for them and their long history as a store of wealth.
What are the possible returns? Gold had a particularly strong year in 2025. Gold returned approximately 27% to 30% during 2025, depending on how and when the return is measured. Silver also performed strongly, returning roughly 20% to 25% during the same period. However, precious metals do not rise every year. There have been periods where gold and silver remained flat or even declined for years.
What are the risks involved? Many people think gold and silver are completely safe, but they still carry risks. Main risks include prices can rise and fall significantly. Prices can remain flat for years.
How much do I need to start?
One of the biggest misconceptions is that you need thousands of dollars. In reality, you can buy fractional gold through many investment platforms with less than $100. Physical silver is often accessible even with relatively small amounts of money. Many gold ETFs allow investors to gain exposure with well under $100. This makes precious metals accessible to most beginners.
Item 6. Corporate bonds. What are corporate bonds? Corporate bonds are loans that investors make to companies. When a company wants to raise money, it can either sell shares or borrow money. When it chooses to borrow, it may issue bonds. Investors who buy those bonds are essentially lending money to the company for a specified period. In return, the company agrees to pay interest at regular intervals, return the original investment when the bond matures.
What are the possible returns? Returns vary depending on the quality of the company issuing the bond. In 2025, investment-grade corporate bonds generally produce total returns in the mid-single-digit range, roughly around 4 to 7%. Higher-risk corporate bonds offered higher potential returns, but also carried greater risk. The return comes from 1. Interest payments, 2. Changes in the bond's market value. Unlike stocks, most bond investors are primarily interested in predictable income rather than explosive growth.
How much do I need to start? Traditionally, individual corporate bonds often required larger investments. Today, however, many bond ETFs can be purchased with $100. Fractional investing platforms have lowered the barrier to entry. Some brokerage accounts allow investors to gain exposure to diversified bond portfolios with relatively small amounts. This makes bonds far more accessible than they were in the past. So far, we've looked at assets tied to companies, real estate, governments, and precious metals.
Item 7. Farmland investment. What are farmland investments? Farmland investing means putting money into agricultural land that is used to produce crops or raise livestock. Traditionally, investing in farmland required buying an entire farm, which placed it out of reach for most people. Today, some investment platforms allow multiple investors to collectively own farmland, making it possible to invest with much smaller amounts of money.
What were the returns last year? Farmland returns vary depending on crop prices, weather conditions, land values, and rental income. Historically, U.S. farmland has often produced annual returns in the high single digits over long periods when both land appreciation and farm income are considered. Recent years have generally seen positive performance, although returns can vary significantly from one year to another. What's important to understand is that farmland investors often benefit from two sources. 1, income generated from leasing the land to farmers. 2, appreciation in the value of the land itself.
What are the risks involved? Like every investment, farmland has risks. Main risks include weather risk. Droughts, floods, and other natural events can affect agricultural productivity. Commodity price risk. Crop and livestock prices can fluctuate significantly. Liquidity risk. Farmland is generally not as easy to sell quickly as stocks. Regulatory risk. Agricultural policies and land use regulations can affect returns. However, farmland is often viewed as a tangible asset because it represents ownership in productive land.
How much do I need to start? This is where many people are surprised. You no longer need hundreds of thousands of dollars to gain exposure to farmland. Some fractional investment platforms allow participation with a few $100s, and occasionally even less depending on the offering. This means that farmland investing is far more accessible today than it was in previous generations. Those are 7 things you can buy with as little as $100 that have the potential to grow in value, generate income, or preserve wealth over time. The important thing is understanding that building wealth doesn't always start with a large amount of money. Sometimes it starts with knowing what options are available and taking the first step. Which of these would you be most interested in owning? Let me know in the comments. And if you found this video helpful, consider subscribing for more content on investing, personal finance, and building long-term wealth.